Good afternoon. Thanks for tuning in. Especially those of you, I know there's spring break going on out there. So if you're on the beach and tuning in, you're especially dedicated. So I want to thank you for that. Before I get into the presentation, I do want to just take a quick second and talk about the market because I can't help myself. So the action today, pretty constructive. If you listen to, we've started a podcast series that comes out every weekday. And I've been pointing out that the S&P 500 has retaken its 200-day moving average. You guys are probably all pretty familiar with that. One of those things that people, don't always admit that they use, but everybody looks at it, right? So, and that level is around, sorry, I'm looking away for a split second, 44.75, I believe, is where that 200-day is. Yesterday closed below prior to the other day, 2 days ago, closing above it. And today is actually kind of an important day for short-term indicators, right? Long-term, someone like Warren Buffett doesn't care what the 200-day moving average is. But if you want to make short-term sort of extrapolations on where the market may be headed, if we do close above that level today, and we're off to a real good start to do so, S&P up about 1% right now, closing it at around 5,000. We can 4,500, excuse me. We can hang out there, then that would be very constructive. Okay. So today we're going to focus on aerospace and defense. And a notion that's not necessarily rocket science, but I think it can be pretty powerful, is that these two different sectors, very related, can actually work together in that you can have some stocks that participate in both verticals, right? And both these verticals might have some longer term legs than maybe one might think. So let's kind of get into this a little bit here. I'm going to share a screen. And I don't know where the slideshow start is. I'm gonna have to call on my faithful assistant Bliss to get my slideshow started, because this is a Mac and this is different. Oh, that thing way down there. Okay. All right, here we go. So Mac reviews, Frank Grinnell Capital. Thanks for tuning in. And we kind of launched into the intro what we're going to be looking at here. So moving ahead. So the bad news is the reason for this talk is prefaced by the war in Ukraine, right? A very sad reality. Us at Grinnell Capital, I'm sure all of you out there listening, stand with the folks of Ukraine in the face of unwanted and unwarranted aggression from Putin and his regime. It's sad and it's unfortunate. We have seen so far the immediate reaction. You look at the market, we had the commodities spike, right? Which makes sense. Think about what a resource-rich nation that Russia is and the Ukraine. All the sanctions being announced against Russia. Globalization, it seems to be fading in the rear view in terms of macroeconomic trends out there. And we've also saw, the market took a little bit of a dip, right? This is just a S&P 500 year to date. As we all know, it's been a rough start, had a real big rebound recently. As the war began, if my memory serves, the market did gap down a lot, but then that was kind of a near-term low. That tends to be the action with war onset and the market anyway. But the point here I want to make is you take a look at these commodity spikes, the market action. These are probably relatively temporary events that have happened. Sure, certain aspects you look at like potash and what have you in Russia, we're not going to be importing that at all anymore. Things like that can have longer term effects that can have an impact. But the big moves you've seen in nickel and palladium and coal and aluminum, whatever, every single commodity has gone straight up vertical. Probably not a long lasting event, right? We're probably going to look back in a year or two and these things will largely be erased potentially. One thing that's probably not going to be the case for is defense spending. It doesn't, we've seen so far that Vladimir Putin he's unpredictable. It's really hard to handicap against someone like this who seems to be capable of doing whatever's on his mind, on his whim. There's more territories that used to be part of the former USSR that are independent, and he may decide that they need to be pulled back into the motherland as well. So that does leave NATO and other non-NATO European countries vulnerable. If we take a look at, just to draw kind of a correlation, just kind of paint a picture for you, defense spending in 2020 for Western Europe on average was 1.9% that of GDP. To give you some comparison, the US is a bit higher. We were 3.7% of GDP back in 2020. I think both those numbers are headed higher. I think in Europe, it just feels like it's going to be headed higher. Germany's already made that commitment. They're going to be spending more. And I wouldn't be surprised to see other, again, NATO and non-NATO members to spend more, just in case, just so these nations can help defend themselves against Russia. Spending will likely be broad-based, right? We're not just talking about, getting new jet fighters and that's it, or just getting a couple new aircraft carriers. You're talking munitions, missile defense systems, air, land defense, all this stuff, I think, is all fair game. So one thing, if you look at and you think about defense stocks, like, yeah, great. That sounds awesome, Frank, but they've had this big move. And I think you might be kind of late to the party here. This is a chart of Lockheed Martin. This is a 1-year chart. And you could tell where it's got a pretty big move from where the war onset was. And Northrop Grumman looks like this. General Dynamics looks like this. A lot of the defense stocks look just like this. So they've had a little bit of a pullback, which is great. This offers entry points, right? Because at the end of the day, two things are going to happen. You've got short-term money. It's just going to get bored of this trade. They're going to take profits. When there's a pause in the war itself, then these stocks are going to go down. There's no question about it, no matter when it is. They're just going to go down on the news. That's just how this kind of thing works. I think those are good entry points and add points as we go. But the bigger thing I want to talk about and take a look at is, let's just take a look at the top 5 defense companies. If we look at Lockheed Martin and we take a look at what really matters, if we look at a PE basis, and this is a company that, for those of you that don't know, Lockheed Martin, they're famous for those fighter jets, right? The F-35s, the newest generation, and helicopters. Stock trades at 16.7 estimated 2022 earnings. This is less than the market. So even, let's just call it in line. Let's call it in line to the S&P 500. These things this trades at an in line to the S&P on a market multiple. And the one thing that we love to do here at Grinnell Capital, we're always trying to ascertain, okay, which directions are those earnings going to go? Or is it the point where consensus estimates are going to be headed higher from here in 22 and 23? Or are the best days kind of here, or really short-term down the road, and are forward estimates vulnerable to come down and be reduced? I would argue the former. I would argue that maybe these earnings estimates are perhaps a little bit too modest. And maybe that 2022, 2023, even 24 numbers are a little bit low on consensus. That would make the perceived price to earnings ratio even cheaper, right? You get a bigger E, the PE shrinks. So that's Lockheed Martin. Northrop Grumman, another major defense supplier. They're known for their aeronautic mission and space systems, incorporated into many segments of defense. This stock trades at about 18 times 2022 earnings. Again, let's just call that in line with the market. Take a look at General Dynamics, known for their warship construction, land combat, and munitions. Trades at 19.4 times 2022 earnings. Take a look at Raytheon, former United Technologies. This one's unique, pretty balanced exposure with defense and aerospace. We'll get into aerospace in a minute. On the defense side, they're known for their missile defense systems. I think the blend of the commercial and the defense gives them a higher multiple than the others, than their peers. They're almost 21 times 2022 earnings. They're the most expensive in the group. Mind you, I don't think 20 or 21 times earnings is all that commanding of a multiple. I think that's totally fair. And I think that there's room for upside there as well. L3 Harris Lhx, another stock with systems and applications on the defense industry. They've also got commercial aerospace exposure. This stock trades at 18.6 times. So the exercise here, and the point I'm trying to drive across, is even though these stocks have moved, they're not expensive. A lot of times they even trade in line, maybe at a discount to the broad market itself. And if you look and think about the secular, what is now probably, unfortunately, a secular growth story, there's probably a lot more to go here. So war stocks in general, you guys have clients out there. It could be ethically challenging for some, and I'm not going to sit here and try to tell you how to position war stocks for people that are absolutely opposed to owning, tools of war and what have you. I get it. I guess the thing that I would say, and the piece of it that kind of gives me kind of, I don't want to call it comfort or whatever you want to say, is in the face of an aggressor like a Putin, as far as Russia goes. If in fact these nations do arm themselves to the extent that it's maybe even intimidating to him, or he thinks for a second, maybe I should just kind of mind my own business because these guys are looking a lot more powerful than I estimated, then these can look a lot more like peace stocks, right? They can, hopefully that becomes the great irony out there, is that as countries fortify their systems, aggressors will take heed of that fortification and back off their programs of aggression. Okay, shifting gears a touch. So with the war going on, implications on travel. So we're talking about now, we're in the private sector, U.S. citizens, commercial aerospace, what have you. Who wants to travel during a war? I mean, there's probably tons of people who had their, what was her name on The View? Poor Joy had her vacation in Italy interrupted by a war. She caught a lot of heat for that, rightfully so, because who gives a rip about her vacation in Italy when there's a war going on? But my point is, a lot of trips to Italy and Europe probably got canceled, what have you. And people are going to travel less, right? People aren't going to be traveling as much. But actually, it turns out on March 15th, Delta, United, Southwest, and JetBlue on the same day all raised their revenue expectations for the current quarter. Why'd they do that? Demand. Travel demand. We're probably for this mostly domestic, but international as well. Just because you're flying international doesn't mean you have to go to Western Europe. And I think that's interesting. That's compelling. And you could say, okay, I get the travel component. People want to get out there. They've been locked up forever. That's a secular trend. I like it. But energy prices are going straight up. Jet fuel is no exception. I don't want to, airline stocks aren't for me. I don't get it on the margin pressure. They're going to get killed. And to my response would be, yeah, I don't blame you. I know we own no airline stocks for that. A lot of that reason, just on the margin hit, it just seems a little too risky to me. So there's a way to play the same sort of trends, the secular reemergence, travel again, open up the economy. People want to travel. Everybody, I know tons of friends of mine that are on spring break right now. They're in Costa Rica, they're in Vancouver, they're on the West Coast. There's people going all over the place. So it's happening, and it's going to continue to happen into the summer. So taking a look at aerospace, very related, obviously. But when we talk about aerospace, so as the number of flights increase and as capacity increases, so capacity, think about that in two ways. One, airlines adding more planes to their fleet, they can fly more folks around. And two, airlines adding more flights to their arsenal of flights that they have. So as those start to go up, and by the way, capacity increases isn't necessarily bullish for airlines, but it is bullish for aerospace. Meaning you're going to need more jets. You're going to need more parts for these jets, not just on a new build OEM basis, but also on a maintenance and repair, ongoing aftermarket spare parts and what have you. So this is another trend that I think has got some serious legs to it. And the poster child here, your friend of mine, Boeing, BA. I say that with a little bit of sarcasm. This stock has been terrible. It's been just the disaster of a performer. What I can say is it looks like the MAX has finally turned around. It looks like they could be headed the right way. The stock still can't get out of its own way. It's still one of the worst performers, I think, year to date of almost anything. It hasn't really participated in the recent rebound. One day, maybe it does. We don't own it. I don't know. We have owned it. And for us, it was just no mas. Misexecution and what have you. It just doesn't, you can only take so much of that. So anyway, that is obviously the poster child in this country when it comes to aerospace. Another one, Raytheon. So we mentioned this on the defense side. I think really interesting here in aerospace. I mentioned they're the former United Technologies. So Raytheon, underneath their umbrella, they've got Collins Aerospace and Pratt and Whitney, engine jet manufacturers, along with General Electric and Rolls-Royce out of Europe, out of England. They also make jets for planes. So super interesting when you think about the implications for Raytheon when it comes to the aerospace business, the defense business, participate in both. I like that a lot. I said before, I think that's probably why it trades at a couple turns higher than its peers. But I think that over the long term, you get rewarded for something like that. General Dynamics, we talked about them on the defense side. On the aviation side, they own Gulfstream, private aviation. Private aviation is absolutely white hot right now. Whether you talk about jet shares out there like NetJets and what have you, there's like 15 of these companies nowadays, to people just purchasing their own planes. The uber rich have only gotten uber richer with the market over the past couple of years, real estate. So folks that are thinking about pulling that trigger on the private side are doing it. These guys are booked out over a year down the road. If you want to go and get yourself a new Gulfstream, it's going to take you a little while. You got to wait in line. So that looks interesting. And then along the same lines, Bombardier, love saying that name, Montreal-based, long ticker BDRBF. This is actually a dollar and change stock. So this is a company that got highly leveraged, and they are working down that debt. They actually, if you look at the news flow, they actually just recently repaid a pretty big piece of debt out there in the marketplace. And the other thing interesting about them that's new to their business, they've done over the past year or so, is they have gone and established their own branded maintenance centers globally, which is something they did not do before. They used to just work with third parties. And if you had a Bombardier private jet, you'd have to get it, fixed by the Gulfstream, hangar, what have you. Now Bombardier has their own self-branded, owned maintenance and repair places all over the globe. That's going to be a good boost of margins. That's good business. So that one's interesting as well. And at $1 and change, not the most commanding price ever. And so, just to think about wrapping up here, secular growth from a sad reality. Here we are with the actions in Russia, and no one knows where this goes. No one knows if, God forbid, the U.S. gets dragged into this thing. Who knows? But it would appear that rational minds and folks of logic, if you are in charge of spending decisions in European nations, you're probably going to spend a bit more on defense now than you would have 6 months ago. I think that makes sense. So yeah, just as we talked about, defense spending probably goes one direction here. And as I touched on, hopefully a great irony unfolds. Hopefully these European countries do fortify themselves. Hopefully that's intimidating even to those who, might be a little bit on the aggressive side, and they pull back their intentions of, continued domination out there. And then on the aerospace, we do think there's going to be a continual gradual improvement in commercial aerospace plays. Like that a lot too, like both these spaces. We own Lockheed Martin. We own Raytheon. Another honorable mention, you can write this one down. I didn't mention this one. This is more purely it's on the aerospace and defense, but thinking more on the aerospace side. TransDigm, TDG, Tom, David, George. They do also aftermarket spare parts, maintenance and repair. Great company. Awesome returns. So I think, okay, Grinnell Capital Commercial. This is what you've really been waiting for. So as those of you who either know or don't know, our mission statement is to help financial advisors build successful practices through our investment models. So accelerator model is kind of our, that's our base, our hallmark. The perfect words escape me right now. Flagship, thank you. That's our flagship model. Stocks and ETFs. That's a strategy that I've been honing for the past 20 plus years. Ignition is an all ETF model based on it, which tries to duplicate the exposures that the accelerator has in terms of sector, geography, theme, what have you. We just started that this year, and things are going well in terms of the ignition model. Also, other things to make you aware of. We're on your Friendly Neighborhood podcast every morning. Street Views, we do it every day. I do also push it out over LinkedIn. So if you, and you should also have it on other podcast mediums as well, but I do push it out, a link to it every day on LinkedIn. And so look out for that. We've got another macro views coming up on April 21st, same time. Don't know the topic yet, because if you know me well enough, I could be a spontaneous kind of guy. So also peer-to-peer events. We have exclusive events that we do. We call them peer-to-peer events, where we get financial advisors, investment folks together. We get them in one room. We have a meal. We talk about concerns in the industry. We talk about investments. We talk about themes that are relevant. We just did one in Denver, really well received, positive feedback across the board. We've got one coming up in Boise, our former home, one of my favorite cities, April 6th. And this is not, even though people don't believe, this is not a sales pitch. No one will be giving any sales pitch whatsoever. So just a great time to increase your network and really learn on what's top of mind and concerns out there, and meet some smart people that have their own sort of solutions they're working on. Scottsdale, we're also looking forward to doing one there as well on April 13th. Thank you very much for tuning in. Check out our podcast and enjoy the rest of your spring break if that's your deal. Here's the disclaimers. This is, you guys are going to want to see this. And here's another one. All right. Thanks very much. Have an awesome afternoon.